The Wyoming Retirement System, we're the administrator for 8 defined benefit pension plans. We have $10 billion under management, and that's separate from all the money at Treasury that you just learned about. In addition to that, we are the plan sponsor of a $1 billion 457 supplemental savings program under 457 of the IRS code. The operation that we're going to describe to you today is basically a good news operation. Mr. Chairman, what you're going to hear is basically a good news story. The portfolio is performing well. We're getting as much juice out of the investment markets as we can. I think we have a good governance structure, at least for us. Mr. Chairman, in my opinion, one size fits one. Every pension fund across the United States, the Treasury operation versus our operation, they're all unique, and they are, one size fits one. And so we're a onesie. I do think that we have a good performance. We have a good governance structure. What Sam's going to tell you is basically the board sets the asset allocation, and we hire investment professionals to implement it. And we don't trade individual securities, at least not normally. We hire managers, and so we're asset allocators. That's how we operate. Sam's also going to tell you there's a timeline slide in there I kind of like. It wasn't always so. There was a day where we didn't have top quartile, top decile results. There was a day where we tolerated pretty mediocre, Mr. Chairman, I would even call it bad investment results. There's a 2007 Management Council audit that made some recommendations that said we need to quit doing this, because back in the day, I think in that report, the retirement board itself, which is the elected state treasurer and 10 people appointed by the governor and confirmed by the Senate, that board was interviewing managers and selecting managers. And they were making individual decisions about to reduce this manager's position or to fire them and to hire these folks. And a lot of the board meetings consisted of those kind of management presentations from investment managers. Basically was a lay board. I mean, these were smart people. They all had the right motives, but there was not a professional background amongst the whole of them in institutional investing. And the results showed that. And the recommendation out of that audit was to start hiring and build out an investment team, which started in 2009. That's the first time the Office of Chief Investment Officer appeared on the WRS organizational chart. It was vacant. Anyway, so what we have today is an outgrowth of some of those recommendations. I would note that back in the day, Polly Scott on the LSO staff, who's present here, actually authored the agency's response on that audit. The agency largely concurred with all those recommendations. Polly, I just point out, you did a very good job. With that, I think I'll quit talking and turn it over to Sam, and he's going to talk you through the presentation. We got some slides. We're not going to try to make it death by PowerPoint. I know it's been a long day. There's some goodness here, and it demonstrates that we're doing okay, that you can make improvements. We did. There's some ongoing challenges to maintaining this. We have resourcing challenges. We need enough people. We need to pay them enough. And the board's philosophy is expressed pretty much as nose in, but fingers out. That's a tough thing to do consistently. You have your nose in too much, it's always tempting to get your fingers in, and sometimes it's hard to define the difference. And that's a continuing operating challenge that I think every public pension or every public money management system has. And we have those challenges too. With that, unless there's any questions of me, I'll turn it over to Sam.
Committee, any questions? Sam, take it away.
Thank you, Mr. Chairman. So Sam Masudi, CIO of Wyoming Retirement System. Thank you for having us today, and appreciate the opportunity to tell you more about the program. So just turning to, Karen's going to help me with this. Just starting on the overview on page 1. As Dave mentioned, the investment program Didn't start until, if you could go to the over, yeah, that's perfect, great, thank you. Didn't start till 2009, and I'll go through the timeline and sort of the drama of getting up and running, but it's worked out very well. Looking at the last 5 years, we've outperformed the benchmark by 1.62% annualized, and that's equivalent of $739 million of excess profit. That puts us in the 5th percentile of our public pension peer group. And our operating cost is only 2.4 basis points. A basis point is 1/100%, so 0.024% of assets. So it's a pretty good return on investment for the state.
Chairman?
Senator Hicks.
Just real quick, Sam, on that. Does that include the internal cost, or does that also, the 2.4 basis points, is that just the internal stuff, or does that include all the investment managers also external?
So that's just internal for the investment group.
Right.
And about 2/3 of that is staff costs, and the other third is like the general consultant costs that we would have regardless if we had a team or not. And when we report returns, it's always net of fees. So we're happy to pay fees as long as we're going to net a return that's higher than the passive alternative.
All right, thank you.
Okay, so I wish I could take all the credit for the success, but I'm one of many people who've been working on this, and our success has been driven by close cooperation between the governor's office and the legislature, JC and CapFin, and none of this would have happened without that. And it's allowed us to build up our team and have a stable team and really improve. And it's been a lot of work for all of us. We really appreciate everything you've done for us. Generally, I think we're well positioned for success going forward. We have a model that works. We just need to make sure to change the oil regularly and make tweaks from time to time. And I think regardless of our performance, we're always trying to improve. I think that people who, if they are performing well for a while, if they start coasting or getting cocky, the market will put them in their place pretty quickly. So I think we're all very aware of that. So turning to page 2 here, I'll just provide some quick overview of the agency. So it was established in 1953. We oversee $11 billion. $10 billion is in the main pension plan. We have another just under $1 billion that's in the defined contribution plan, which is, the people have an election, whether they want to participate in that, then it's self-directed. 106,000 participants, so 40,000 current employees, 10,000 inactive vested employees. So those are former employees that are vested and they'll receive a pension when they retire. We have 35,000 retirees, and we pay $750 million of distributions and benefit payments every year. There are 22,000 inactive non-vested members, so those are former employees that didn't work 4 or 5 years to get vested. There are over 700 reporting agencies, so there's the employers and $418 million of annual contributions. So every year we've got 3 to 3.5% cash outflow that we manage. And from my standpoint, I'm managing one portfolio because they have a lot of similarities. So there are 8 underlying plans, though the main is the public employee plan, which is 85% of total members. And there's 7 smaller plans for law enforcement, firefighters, et cetera. Our funding ratio is 77.25%, and I believe that's a little bit above average. There aren't many state plans that are 100% funded. I think South Dakota might be, Idaho might be close, but we're probably above average, and there's no reason why a plan has to ever be 100% funded. It can operate forever being less than 100, but I think our goal is to get to 100, and we're on track to do that.
Yeah, Sam, I might jump in here and just make sure everybody understands what we mean by a funding ratio. You have your assets that you have on hand, and you compare that to your liabilities. And if the assets equal the liabilities, I guess you're 100% funded. The liabilities are calculated by our actuary. If you think about it, we have all these pensioners that we're paying right now. We know exactly how much money they're getting. We know how old they are. And you can figure out year by year, month by month, what the cash flow is likely to be, how long these people are going to live, and so on. And we have a pretty good idea of people that are nearing retirement. We have a good estimate about how much longer they're going to work based upon prior experience, and we know what their highest average salary. Anyway, we can estimate the liabilities year by year, then we discount those back to present value using the assumed rate of return of the system, which is 6.8%. And then you compare the two. And there's two ways to compare it. The usual way we compare it is on actuarial value of assets. That means we smooth it over 5 years. So we lost 7% last year, 6.99% technically. We only book 1/5 of that for actuarial purposes, just as we only booked 1/5 of 2021's 17% gain. Because we know that markets are going to fluctuate year to year, and we think that's a better way to kind of view where you're at. And on an actuarial basis, we're right around 77% funded. And we're going to get there eventually. But it's a slow and uncertain path, and nobody knows how long it's going to take. And a lot of that, of course, is driven by the assumptions, like that 6.8% investment return. What discount rate? That's the biggest thing. At one point in time, it was 8%. The board has reduced that from 8 to 6.8, taking 120 basis points out. That's added more than $1 billion to our liabilities. So one way you think about these funding ratios, it seems to me, is whatever your assumptions are, all right, let's say you're fully funded. And then if you want to reduce it by another 20 basis points, now you're not. Stroke of a pencil. And then the markets can give you an adverse result like they did last year, the stroke of a market. Now you're not. And the same thing can be on the upside. So that's what that funding ratio really means. And in the end, I think for a fund like ours, what's important is not only where you are in time, arguably that's your position, that's your funding ratio, but know the assumptions. I could say we're 100%. I think you have to wish for a 9% compounded return. Not realistic. But if you did, then you're fully funded. But also think of speed and direction. Are you growing or are you shrinking? And how fast? And are you comfortable with that? And so I think the direction is positive. The speed is a little slower than some would like. That's where we're at.
So what are the main variables as far as attaining a higher percentage? You said that you kind of have this goal of going toward 100%, but what variables would have to change to do that?
The biggest variable is investment returns. 70% or so of any individual pension benefit ultimately is paid for with investment results. And it's investment results that are the most meaningful and the most volatile of all the things that affect our progress towards full funding. The other things are impactful, but far less so. Things like experience, people living longer. In the pension system, sometimes I wonder how I got hooked up with this industry. You know, living longer is a problem, but you just have to be realistic. If people are living longer, they draw a longer benefit, that increases your liability. It's just a fact of life or death. And then the other thing that can happen is you can get adverse payroll experience. We've got a little of that going on in Warden and Patrol right now because the Patrol hasn't been able to fill their ranks. And if you have a contribution rate that's in excess of the normal costs of the plan, which is what it takes to fund an individual's benefit, that's how you're growing the plan. So each individual officer that we hire that pays that full contribution rate is helpful towards gaining towards full funding. Well, they've had trouble manning the force. They've got vacancies. Vacancies don't help us. So in the end, it kind of comes out as a payroll growth not meeting expectations. And so that's the other thing that can affect us, as well as just the overall contribution rates. One of the things that impacts the fund not only is the history of the investment operation, which I'm digressing from, but we had a history of pretty low contribution rates for 30 years. I was around 11.25% in the public employee plan. It was held that way from 1981 to 2010 when the legislature started to increase those. So that's the lever you have, really, is contribution rates. You can't get out of the markets what the markets can't give you. I mean, there's a limit to what Sam's team can do. You can get best in amongst peer results, but everybody lost money last year. So I think in the end, you have to manage all of those things. But investment results are the most impactful, Mr. Chairman.
Okay, thank you. Carry on.
Yeah, and Mr. Chairman, I think a good rule of thumb is for every 1% change in investment return, it impacts the 30-year funding ratio by 3 times that amount. So if we outperform by 1%, that'll improve the 30-year funding ratio by 3%. And so we're rarely going to have a return that's 6.8. You know, it might be 10 or 15 or -7 like last year. And so you end up with these big swings in the 30-year funding ratio. So we may show you the 30-year funding ratio now. A year from now when we come, it's going to be much different. But that's just sort of the nature of the markets. So turning to page 3. So this is the governance. So there's WRS is governed by an 11-person board. So it's the treasurer plus the governor appoints 10 members for 6-year terms, and those are confirmed by the Senate. And of the 11 members, there can't be more than 75% from one political party. And of the, there have to be 5 pension participants, 2 school-related, 2 non-school-related, 1 retired. Then there have to be 5 at-large members with at least 2 having substantial institutional investing experience. Right now, I'd say we have 4 or 5, so that's been very helpful. Down below, you can see the makeup. So the board hires the executive director, and then the executive director hires me, hopefully never fires me, but he certainly has that capability. And then the investment committee is a subcommittee of the board, and I work closely with them as well. Going to page 4, this is what Dave had mentioned. This is historical. It's a 20-year period or so for WRS, and it shows that of the benefit payments, 70% were funded from investment income, which just reinforces how important the investment program is.
And Sam, I'm going to digress for just one moment on that topic, because I think it's an important one for stakeholders to understand. You know, you don't have to pre-fund a pension. That's really what we're talking about when we talk about these funding ratios that we discussed earlier. I'm a military retiree, and there is no investment corpus in the Department of the Army. There's nobody managing the pension fund for the Department of the Army. It's a line item in the DoD budget. It's a pay-as-you-go system. In that case, the investment income goes to 0, and contributions from the employer really make up 100% of that. Is that wrong? Is it immoral? No. Again, one size fits one. If you're the federal government, I guess you can do that. And the retirement expense is not very big compared to the DoD budget. In fact, the state of Wyoming actually has a little bit of history. There's 14 retirees in the legacy judges fund out of the budget of the Supreme Court. It's just a line item in the budget that you all approve every year. It's about $1.4 million for those 14 remaining individuals that were part of that legacy system because they had the choice to elect to go into our judges plan or not. Is there anything wrong with that? There's no investment corpus there. No, there's nothing wrong with that. One size fits one. The point, though, is that if you do this right, a model like this is the most efficient. It means you're going to have investment returns pick up the bulk of the pension expense, and that reduces the expense for the employer and the employee. And that's why you want to manage this fund. That's really what it's all about, my opinion.
Okay, turning to the next page. As we look at the funding ratio, there are 4 levers that we have available to close that. The first is increasing contributions, which is really painful because it means then employers need to find the money in their budgets, and budgets are usually tight, or employees have to contribute more and they don't have as much disposable income. Second is to reduce benefits or push a COLA further out. That's painful. Third is our operating cost. You think at 2.4 basis points, Even if we could eliminate that cost, it would take 1,000 years to close the gap, which is not a very attractive time frame. Our operating cost is really almost like a rounding error. And the fourth is increasing investment returns. So it's not, if contributions are increased, that's, very, very predictable. Higher investment returns aren't as predictable, but they're achievable, and they're the lowest hanging fruit, I would say. So if we had a 1% higher return over a 25-year period, which isn't easy, that would close the gap. And I mean, we aren't including compounding here, but less than 25 years. So, as Dave was mentioning, we're on a trajectory to get to fully funded. But if we just assume that 77%, if that was going to be stable, those would be our 4 options for closing it. Turning to page 6.
Mr. Chairman,
Senator Hicks.
I don't see number 5 on there, gentlemen.
What's that?
Well, you increase the age to be eligible for benefits.
Yeah, Mr. Chairman, Senator Hicks. Yeah, that would be a number 2, reducing the benefits
You're going to
somehow.
include that in the benefit component.
Right. And that's one of those issues that anytime benefits are reduced, if somebody's looking for working for the state, they're going to look at that, and to the extent that value is lower, you might expect more in cash comp. So it's not, there's really no free lunch, unfortunately, but yeah, that would certainly be one possibility, or having another tier, or, yeah.
Yeah, Mr. Chairman, I know we've looked at that with the Appropriations Committee and early discount rates and extending, I mean, what's going to save Social Security, but we don't do that. So what's the full benefit retirement age right now, 62?
In our system,
Correct.
it's age 65 for tier 2. There are 2 tiers of benefits in the public employee plan. And I talk a lot about the public employee plans, 88% of our business, and that's where most employees are. The state, by the way, is only about 25% of that, 75% is local. But yeah, there are 2 tiers. Tier 1 is a legacy tier, and it had a normal retirement age of age 60. And Tier 2 was adopted in 2012 and has a normal retirement age of age 65. And what normal retirement age means is that that's the age at which you can draw your benefit, and it will be unreduced from that basic formula. If you retire earlier from that, you can still retire, say, at age 64, but you take a 5% haircut for that year. If you're retired at age 63, you get a 10% haircut. So that's how that works. There are a couple of systems that have moved to age 67 as a normal retirement age. But the majority of systems are right around 65. And we're not unusual as a state of having a legacy tier at age 60, which is still kind of what most people retiring this year will be, tier 1 retirees. Does that answer your question, sir?
Yeah, it did. But if what's the discount factor that Social Security uses? We're using 5%.
It's about 7 point something, between 7 and 8, depending upon your age. There is a thought from the actuaries that maybe we ought to use the assumed rate of return, because that kind of is a neutral situation. If you have something less than that, you're somewhat encouraging or subsidizing, I guess, early retirement. If it's more than that, you're discouraging it. Probably the pension should be agnostic on that, I suspect. The 5% is actually encased in legislation. The statutes say the board can set that, but your predecessors back, I believe in 1990, in the budget bill, put that in at 5%, and that's kind of one of those non-codified budget things that's out there. We have looked at that. I've had the actuaries analyze that and said, well, what happens if we up that to, say, 6.8%? Either by have you all do it, or at least let the board do it. And it doesn't really affect very much, because most people work a little bit beyond their normal retirement age anyway. It would affect a little bit, but not much. But there is a little bit of a factor there.
Follow up? Okay. A question about the COLA. Do all of your funds have COLA adjustments, and can you talk to us about that? What that looks like?
Mr. Chairman, that's a real short answer. The answer is no. We don't offer any cost of living allowances. The board used to. There's a history of the board awarding about a 1% COLA on average up through 2008. And then after the great financial crisis and the stock market fell, the board did not approve any other COLAs. And then in 2012, legislation was enacted saying that the board cannot even recommend a COLA because all these COLAs that were recommended by the board were approved by the legislature. But the law now says the board can't recommend a COLA to the legislature unless the plan is fully funded, plus an allowance for what the COLA would cost, plus an allowance for market fluctuations. And basically that means to give them any meaningful COLA, plan's probably got to be about 115% of its funding ratio. And so we haven't paid a COLA since 2008. And since none of the plans are meet the criteria, there hasn't been any proposal for a COLA. The only, there are proposals every year in the legislature, as you know, for the legislature to fund a COLA or to even, or just tell the retirement system to pay it and take it out of Hyde. And that's because there's growing pressures, as you can imagine, on retirees, and you get that from your constituents. That was also one of the governor's proposals last year in his letters to y'all. He proposed funding a COLA, and that didn't get any traction in the last session, but there have been proposals every session for something to do something with that.
Mr. Chairman, just
Just a minute. So on that piece, have you done modeling of what different levels of COLAs would look like in terms of the percentage of this funding percentage? And
In general, kind of dovetailing back to what Senator Hicks was talking about with the discount rate for Social Security, 7% is about what it costs. So if we have a self-funded COLA option, for example, and for an average, it all depends upon exactly what your age is, but for a typical retiree, if their benefit is going to be $100 and they take the self-funded COLA option to pay a 1% COLA to themselves, but we'll keep it actuarially neutral, we're going to reduce that benefit by about 7%. It's going to start out at $93. That same formula kind of works on a funding ratio basis. If you were a fully funded pension plan, say we were 100% funded, and then we decided, well, since we're 100%, we're going to give a 1% COLA and build that into the benefit formula. That's going to cost you about 7% in your liabilities. You're now 93% funded at the stroke of a pencil. Kind of how that works.
Senator Hicks.
Yeah, Mr. Chairman, just kind of a follow-up on that, and we skipped over it real quick, but back on page 2, when it talked about the funded ratio, we've got the one plan that's a defined benefit pension, and then the other one's a defined contribution plan. I'm assuming that the defined contribution is the 7 smaller plans, or what is the defined contribution plan?
Yeah,
Who's
Mr.
in
Chairman,
that?
Senator Hicks. So that is the voluntary deferred compensation plan where people can have a portion of their
Okay.
wages set aside.
It's our 457 plan,
Yeah,
which is, in simple words for folks, and maybe that's a 401k for government.
yeah, okay. Okay, I'm with you now. Really, literally, with you on that one.
Okay. Yeah, Mr. Chairman, and I guess, Karen, if you'd like to turn to page 6.
Yeah.
We're laser focused on net returns, and we'll invest whichever way we need to maximize returns. So it'll either be active or passive, private, public, whatever we need to do, whatever's going to produce the best return in that environment. We want to always communicate clearly and provide visibility into the resources we need to do that. And we want to make sure that we're always giving stakeholders confidence that we're investing the money prudently and they understand what we're doing and how we're doing that. Turning to page 7, this is timeline. So 1953, the agency started. 2008, so there's no investment team at all until 2008. It was run by a consultant. I think the deputy director helped manage it in his free time. So it was for a large pension, that was a little unusual. In 2008, there was a financial crisis, and the WRS portfolio declined by 30% versus 24% for the benchmarks. That's significant underperformance, and the peer set was down 27%. And at that time, so the 10-year underperformance of the portfolio was equivalent to 500 to 600 million. So it's a very expensive way to save a little money on staffing costs. At that time, the 10-year performance was in the bottom 5th percentile of the peer group. In early 2009, partially in response to this, the governor replaced 4 board members with new board members, one of whom is Laura Ladd, who I know many of you know, and she did a really wonderful job as a board member, the chair for many years. And they hired a CIO at that point. So they hired a CIO, and he may have had 1 analyst. So going from 0 to 1 or 2 people, but it still wasn't a robust organization. So the first CIO was around for a couple of years. In 2011, he left, and one of his people was promoted to CIO. He was around for 2 years, and then he left, and then I came in at the end of 2013. So I've got the longest tenure by a few multiples at this point. So one of the things I did in 2015, I came up with a 5-year plan, and it had to go through the process of getting the not only board approval, but then the governor and the legislature. So we weren't really able to implement it until 2017. And one of the main parts of that plan was increasing the staff size from 4 to 7. Some of the other highlights in 2019, performance comp was implemented. That was incredibly helpful. We would not have the team we have today without that. That made us much more competitive with hiring and retention. And by 2021, we started really see some of these results improve. So the 5-year performance, the peer ranking, we reached the top quartile. And by just earlier this year, we made it into the top 5% for the 5-year return. So that's like performance in some bull markets and some bear markets through COVID. And then the legislature also approved increases in compensation this year, which is also very, very helpful and will help promote staff stability.
Mr. Chairman?
I guess congratulations is in order, gentlemen. It's very good news.
Yeah, and I think given the performance, I would expect with the increase in performance or the compensation increases and the trajectory, you guys will be in 1%, Kyle, in 2 more years, right, Sam?
Hopefully, if all goes well, yes.
No hope.
Fingers crossed.
No, you guys are doing an outstanding job.
Mr. Chairman,
Thank you,
I might
Senator.
mention, when we talk about these peer results, and we're going to talk a little bit more about them, generally those are provided by our investment consulting firm. And I think the latest set is there's 59 funds that they look at that are public funds that are of $1 billion or more assets under management. So you're looking about the universe of like that. And of course, one size fits one. We're unique, but I still want to beat Idaho. I definitely want to beat Oregon. I want to beat Montana. Definitely want to beat Colorado. There's some other funds that have done well because we haven't always been on the very top. But and you're not going to be on the top every year. That's the other thing I would tell you that, and I've learned this from Sam. It's not me, but frankly, if you get decent results, even just median results, year after year, over 3 and 5 years, you're going to be in the top quarter because most people cannot do that. And it's really the long-term compounding results that matter here. It's not what you do in any one given year. So we're not about hitting home runs. We're trying to get on base. We'll take a bunt. We'll hit a single. We'll take a walk, to use baseball terms. But we're going to consistently do that. We're always going to have people in the game, and we're going to have people on base, and eventually we will score. And we will do that enough, and we will win the game that way.
Going to page 8, just an overview of the 5-year plan that started to be implemented in 2017 is we created a more of an institutional framework. So when I arrived, the previous people did a great job with the resources they had, but a lot of information was being sent to people's individual computers. It wasn't centralized at all. And so if somebody would leave, it'd be like, where's that person's computer? We need to track down what's on their hard drive. And so we have everything more centralized, so it's less dependent on the people. We've really improved the transparency and governance. So I think at the time, there was a little bit of mistrust between the staff and the board. And so one of the things we do is we send weekly report to the investment committee explaining exactly who we're meeting with, what investments we're considering, which investments we've just made, so they always know what's going on. Then they receive a lot of information from third parties that are monitoring the portfolio, and they receive it directly from them. So that's another extra check. We have a system called Tamale, which is our centralized database of all information, so we can put all of the audits and fund statements, and when we visit with managers and take notes, we can put them in there. So it's a good centralized source for all that information. It's in the cloud, so we can access it everywhere. I think we've done a good job of developing talent. We've hired a lot of great kids out of the university. We had a 3-year analyst program, and we've had 4 graduates of that too, who now work at in Treasury. One of is Caleb, the other Seth, and 2 who work at the foundation. So I think some of the work we've been doing has helped other parts of the state.
Yeah, Mr. Chairman, Caleb Simpson, who was one of your primary briefers over in the war room over there in Treasury. Yeah, he WRS graduate, and so is Seth on the other end where I was standing. Yeah, proud graduates of WRS. Everything they learned from Sam.
I don't know about that. They teach me a lot too. But we also launched a summer intern program, which has been a great hiring tool. So over 9 years, we've had 15 summer interns, 13 have come out of the university. We've hired several of those. So that's been a great way to provide them with experience, then also have a little bit of a courting process where we can see if we like them, they can see if they like us. And then we've improved the IT and communications as well.
Mr. Chairman?
Senator Hicks?
Sam, real quick, what grade do they have to be in at the university to get in? Do they got to be junior level, senior level to get into the intern program?
Yeah, Mr. Chairman, Senator Hicks. Yeah, that's a great question. So typically we're looking for juniors who have some finance or economics related background. And the idea is that if we then need to hire an analyst the next year, they're teed up and ready to go. So if we hire a freshman, it's going to be a few years before they're ready to be hired. So I think that, yeah, that sort of the graduating the juniors are sort of the sweet spot.
So Mr. Chairman, follow up, how many applicants do you routinely get versus available positions?
So it's changed over the years. I feel like we've been getting fewer in the last few years, but we probably get 40 or 50 for 1 or 2 positions. And there are a number of people who aren't necessarily qualified. So typically, like, we've been thrilled with the kids we've had as interns and that we've hired out of there. We're typically getting, the best and the brightest at the top of their class. And, often they were valedictorian of their class somewhere in Wyoming too. So we've been very pleased with the ones we've gotten. Going to page 9. Part of the 5-year plan was to establish teams that would focus on individual asset classes. So when I came in, there was a generalist approach of everyone was kind of working on all asset classes. So instead, we have 2 people focused on each asset class, and that improves their expertise and makes the whole operation more efficient. We launched the private equity program. We've committed $1.5 billion to date, and that's really helped with returns too. And we've in any given year, we'll make somewhere between 0 to 2 sort of large internal investments. And so we've made probably 7 or 8 over the years, and we've produced a return of about $75 million. on those. And one of the nice things about it is there are no management fees associated with that. So generally, they tend to be more sort of fat pitch ideas. And I think that, given the turnover when I came in, being the third CIO within 4 years, I think that we were a little bit of a laughing stock, and that people are like, oh, there's a revolving door over there. People just come and go. And I think with all of us collectively having stabilized the staff, I think we've started to get recognition among our peers. And Tom Chapman, who's our board chair, has done a great job of getting out there and getting to know people and really being a great ambassador for Wyoming and getting people more informed as to all the good things that are happening here.
Mr. Chairman, sorry,
Yes,
but
go ahead.
just questions on this. So Sam, when you guys do the private equity program, who does the due diligence on these? Do you have initially first cut with staff, or do you? I know in this we had this discussion earlier with treasurers. And so they'll have staff that do it, then it goes up to the IFC and they review it, and then RVK takes a look at it, and it's the risk management component of due diligence associated with it. How do you guys do that within WRS?
Right, Mr. Chairman, Senator Hicks. So within privates, we have private equity, private real assets, and private debt. So private debt, we do directly. We have a senior officer, Ben Bowman, who's picking those individual funds. Then as a team, we discuss them and approve them. Within real assets, most of it we do through what's called a fund of one. So it's an external manager, and we're able to negotiate very attractive fees. We control the account. They make recommendations, they do all the due diligence, and then we have the ability to veto those recommendations. So it's almost like staff extension. We've been very happy with the way that's worked because we'd never be able to hire teams of that caliber here. That gets back to, we're laser focused on maximizing returns. If we can get it done better outside, we'll get it better. We'll do it outside.
Would that be a good analogy to say kind of the same role that RVK plays on that, or the treasurer's office on these public or private equity programs, or not?
Yes, Senator Hicks, it's a little bit different because the firms that we have doing this for us, many of them have run funds and they're putting a lot of money to work. They aren't necessarily just consultants.
Okay.
And I'm not saying anything bad about consultants, but it's a little bit different. And the firms we use are putting their money in as well. So they've got, I think, good alignment too.
All right, thank you.
Turning to page 10, I think next few pages are the most important part of this presentation. I think we can get up here and show you some fancy slides and graphs and tell you about what we hope would happen and wish would happen. But at the end of the day, we need to produce numbers. So these are the returns over various periods. The first is our actual net return going back those historical periods, and this is as of March. The next is a strategic benchmark. So that's the return that would be earned based on the asset allocation the board sets. If we were to invest passively in all those asset classes at those targets. And to the extent our job as investment team is to invest differently than the benchmark, to invest with active managers and to adjust exposures. So when we do that, that produces underperformance or outperformance. So that's that third line. As you can see, they're all positive numbers that are going back 10 years. And especially over the last 3, 5, 7 years, as our 5-year plan has really started to get traction. See, over 5 years, we're beating by 1.62. Even over 7 years, we're beating by over 1%. And as a general rule, if we're beating by 50 basis points, I would be really happy. So I think this has really exceeded my expectations. And then on the next line, the peer ranking. So is a percentile. It's different than the SATs. Lower number is better. So looking over 5 years, we're the top 4 percentile. And most of those numbers are, well within the top quintile, except for the 10 years. So that's about at median. And the reason is you look at the difference between the 7-year at top 13 and the 10-year at 52. That means the years 8 through 10 were not so great. And then the last 10 have been really strong. And so we performed well, I think, in some difficult markets with COVID, with interest rates rising last year. So that's what we like to see when I think that's sort of the base of a really strong record, is performing well in those down years. So we're pleased with that. And then at the bottom, that shows the value add, so our performance over benchmark in dollars. So we tell you we outperformed by 1.6%. That sounds nice, but it's helpful to put 700 million figure on that.
And Mr. Chairman, just to be clear, when Sam says we're going to invest a little differently than the benchmark or the asset allocation set by the board, within limits, right? So the board says 20% in domestic equities plus or minus 3%, and it's Sam's team to oscillate that 3%. Some of which is going to happen with the market, But if you make an underweight or an overweight to a broad asset class that you think looks good or doesn't look good, that's where you invest differently than the benchmark. So they have to follow the asset allocation within the limits established by the board. And the other thing I'd mention is on this chart, the 10-year number, 52 percentile, that's just kind of mediocre. 50th, middle of the road. If you go back further than that, 2008, Sam told you the percentages, we were down 30%. The average for the benchmark was down 24%. The average fund was down 27%, all that. We were significantly, we ranked in the 90th percentile. That means 9 out of 10 funds did better than we did, not good. And we didn't recover as quickly either. We lost more money in the Great Recession. We didn't recover. And 2011 was a difficult year for investing. I think WRS lost 1.5%. Most funds gained 2%. It's another 3.5% delta. And we ranked in the 95th percentile on one chart I saw. I mean, those were not good investment results. Back in the day when interest rates were higher, back in the 90s, maybe that was tolerable. But in the 2000s, when you had the dot-com recession and the Great Recession, those chinks in the armor became pretty obvious. And of course, those are legacy results. Had we not lost as much money back then, and had we made more money on it, if the market goes up 10%, 10% of what? How much what did you have? Well, we didn't have as much. And we can, that is an anchor that we can, is still with us today. It's starting to fade. The 10-year is now, okay, at least your median. But I think it's been a good news story. And if you keep on doing it in another 10 years, we'll look really good. And again, it's not about hitting home runs, because to do that, you got to take a lot of risk. And you might get lucky. Nope, we just look for fat pitches and we're willing to take a walk. We're just trying to get to first base. We'll take that and do it consistently.
Mr. Chairman. So turning to page 11, this just shows the progression of our performance relative to benchmark. And this is our 5-year return rolling. So we were close to benchmark until about 2018. And then you see it really starts to take off as we got traction, going up to 1.6 currently. And 1% improvement in returns is an extra $100 million. So really can have a big impact. On page 12, it shows the performance relative to peers. And we talk about benchmark relative performance, peer relative performance, and performance relative benchmark is the more important of the two, because that reflects our performance relative to our customized benchmark. That being said, it is always interesting to see how we're comparing to our peer set. So what this shows is the black line at 0, that's the median return over time. The red line is WRS, so that's our 5-year annualized return. And And then the two dark blue, that's the bottom quartile and the top quartile. So if the red line's ever below that lower blue line, that means we're in the bottom quartile. If it's ever above the sort of that second blue line, that means we're top quartile. And then the lighter blue line is top 5%. So as you can see, we're kind of bumping around the lower quartile for a long time. And then in 2018, we started improving. We got to be above median. A couple of years ago, we got into the top quartile, and now we're in the top 5%. And we're going to have periods of good performance, bad performance. We're enjoying this now, but we realize it's not always going to look like this. A few years from now, we might be here saying we had a tough year, but we're focused on the long term, and we're starting to put together a really nice long-term record. So turning to page 13.
Mr. Chairman?
Go ahead.
You know, just looking at this, one of the things that would help you guys tell your story, if you would take page 7 and put those events on the graph that we just looked at, I think it would certainly help us from the legislative body as we continue to look out, you know, for performance compensation, more staffing, and those type of resources. From my perspective, is on the policy side, I would attribute a lot of this success to these things that we've been able to work with you guys to build out the office and provide the performance compensation. And I think by putting those things in that graph and say, this is what changed here, 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 that's led to this, and some of it is not all attributed to that, but I think a lot of it probably is, and I think it would tell a much better story.
Yeah, Mr.
In your
Chairman.
spare time.
Right. Yeah, Senator Hicks, I think it's a great idea, and we'll definitely do that. Okay, turning to page 13, just to give you a sense of how we make, how we've produced these returns, is the 5-year performance attribution. And so there are two main sources of return. One is the allocation effect, so that's adjusting equity up or down relative to target or the other asset classes up or down. So if we're overweight equity and equity outperforms, we'll get a benefit of that. If equity underperforms, by being overweight, that'll count against us. So the blue is the allocation effect. And then the green is selection effect. So we're selecting managers, and to the extent that they're outperforming the benchmarks, they're adding to the positive return over a benchmark. So the top line is the total portfolio, 1.66 outperformance. About 25% of that was from, or smaller than that, I guess, 25 basis points rather was from allocation, and the remainder was from us selecting managers and them outperforming their benchmarks. And these ratios will change a little bit. You know, last year, I think it was about 50-50. But one of the things we like to see is that if you look at all the different asset classes, like across asset classes, they're generally all contributing pretty big numbers. Our marketable equity was a little bit under, but a lot of the private equity did really well. Marketable alternatives did really well as well too. So that's good to see.
And Mr. Chairman, I think the point there, we don't get everything right. Marketable equity, we thought the market was expensive, and we kind of stayed away from it, underallocated to it. The market didn't agree and went off on us, and that was a detractor. Sam has a quote, I kind of like it. We hope to be right 60% of the time. We're going to make mistakes, and we're not always going to be able to be right. But hopefully more than half, and if we hit 60%, then we'll do quite well. Really, that sounds really bad. If you're a surgeon, you don't want to be 60% right. But in the investment community, you just have to be humble and recognize that the markets will teach you a lesson. Sometimes there's a little bit of a lesson there, but overall, we did pretty well.
Right. Yeah, Mr. Chairman. Yeah, one way to think of risk is that a lot of different things can happen, but then only one of them will happen. And no one's going to know every time what that is. But if we make enough investments over time, if we're right 60% of the time, it doesn't sound great, but that's a 3-to-2 ratio. That's all we need to do. And that's what some of the best investors do. And if you look at someone like Warren Buffett, like, he makes losing investments. So we have realistic expectations of what we can and can't do. We can't predict what markets are going to do, but sometimes we'll have a differentiated view. And I think we're good at picking managers. So I think that's what's helped us. Turning to page 14, this is
Mr.
our,
Chairman,
Go ahead.
again, a real quick question on this. So Sam, are you guys limited by your asset allocations? Looking at some of the stuff the Treasurer's Office does, they're into MLPs and hedge funds and stuff. Are you guys structurally limited as to what asset classes you can, or you just choose not to work in some of those areas?
yeah, Mr. Chairman, Senator Hicks, within each asset class, there are limits. So within equities, it'll say, well, within the US equity bucket, they have to invest in all US equities and they can't use leverage and things like that. But we have the flexibility to invest in MLPs, which are publicly traded stocks, and we have the ability to invest globally. So there aren't too many asset classes that we wouldn't be able to invest in. Can we invest in crypto? I don't think there's anything in our IPS that says we couldn't, but we send these weekly updates to our investment committee. If we were even thinking about it, they would know about it, and they might call and say, like, well, why are you thinking about investing $50 million in Bitcoin? And we would have to explain that. And Dave would know too. Yeah. Yeah, right. So, as a public pension, it's interesting. It's like, this isn't my money. This is the money that belongs to 100,000 people, and I have a fiduciary duty to invest it well. And I think that there's certain investments that have high return potential, but they also have the potential to go to zero. And we never want to be in a situation where we're explaining why we made an investment that went to zero. We are going to have 40% of the time, we're going to have some losses, but we just are trying to avoid those real bad blowouts.
Well, Mr. Chairman, the reason I asked that question, because we had to pass several constitutional amendments to change the permanent funds to be able to, but you're not limited by that with WRS. It's the range of investment asset tools you can invest in.
Yes, Senator Hicks, that's correct. So the board decides, and the checks are, if the board wanted to have some crazy asset allocation, the governor could always replace 10 of the 11 members.
Sure. All right. Thank you.
Going to page 14. So we are a very lean staff. We have the blue boxes are current staff. The white boxes are just by function. So we have 7 investment people and 1 accounting person. We have no operations staff. So right now, the investment team is also doing the operational activity as well. So we're like a small startup company in some ways, in that everybody's doing a little bit of everything and everybody has great attitudes about it. But ideally, we'd have more sort of dedicated operational people who just specialized in that. But so a very lean team for managing effectively $11 billion. Turning to page 15, this shows some of the staff background, and I would hope the takeaway from this is that the people on our team have had a lifelong interest in investing and in economics and markets. So everyone has at least 1 degree in business or finance. Looking at the experience, years of experience, the 4th column over. So several of the senior people have 2-3 decades in investing, and at WRS, 3 of us have over a decade. So that's part of that stability. And some of the younger people have worked their whole career close to it with us. And the CFA, the Chartered Financial Analyst designation, is it's a 3-part test, which is extremely painful, but it's really, I think, the gold standard investing, and it shows that people really understand a broad range of, have broad knowledge about investment markets and different securities. And so that's one thing we require of everybody. Everyone has one except for our most junior person. He's taking the 3rd level of that soon and will likely pass. And then there's something called the CAIA, Chartered Alternative Investment Analyst designation, and that's more, even more specific to what we do, and 4 of us have that. So I think this shows a real commitment to what we do and a real love of what we do. Turning to page 16, just briefly, this shows our asset allocation. So the green is marketable equity, that's publicly traded stocks down in the bottom left, and then private equity to the right of that. Our portfolio is very equity heavy because we have a long-term focus, and over time equities are going to perform the best. There'll be more short-term volatility, but we can withstand that. We can tolerate that. We have allocations to private real assets, then fixed income. We have a small allocation to gold. So this is the allocation that the board sets. Turning to page 17. So we invest through active managers, but then we also have passive index exposure. So our baseline is passive, and we only invest with active managers to the extent we think they can add value. We don't feel like we have to invest with active managers. So within the public securities, we're split about 50-50. In terms of relationships, we have 60 external managers. We have multiple funds with some of them. So we have 88 funds total. And then within the private funds, there's several underlying funds. We have about 234 looking all the way through. Turning to page 18, I think one of the benefits of our governance process, and I think one thing you'll hear Treasury talk about that's can be difficult for them, is getting investments approved. And so the WRS board has investment authority, which they delegate to the staff. And so I approve investments, which Dave then approves as well. And typically, all investments we vote on as a team. And so everybody knows what the investments are. It's not like I have the ability, or that I would just make some investment without consulting anybody. So it's a very collaborative process. And I think by delegating to the investment team, it makes we're able to invest much more quickly, respond more quickly. And I think, given that we all have investment backgrounds, I like to think we're making maybe slightly better decisions. Turning to page 19, so in operations, we have a number of risk management tools we use. For a total portfolio, we use a firm called Allborn. Then Makita is our general consultant. They're the equivalent to RBK for the Treasury. And then we have look-through exposure by portfolio using individual tools for those. Turning to page 20, compliance and oversight. So Northern Trust is a custodian. They hold all of our assets, and they're effectively ring-fenced. They aren't exposed to anyone else, and nobody at WRS touches them or has possession of them. So it's a really well-structured framework that prevents fraud or bad behavior. And then as mentioned, the board has great oversight. We have an excellent relationship with them. They're getting regular information at the investment committee level, and then during our quarterly meetings. We have an internal audit department, which is the internal watchdog, and they will audit the employers and the retirees from time to time. And then they also are monitoring us as an investment team. So they're getting all the compliance reports, and they get our weekly updates. And so that's a good check. Makita, as mentioned, they're the external fiduciary. They report to the board. And so they're also keeping an eye on us. That's another check. And then for cash movements, those typically require 3 or more people, and the investment team can't direct cash transfers to anybody. So that's further protection.
Yeah, just to kind of explain how that works. Once we have an investment manager set up, first of all, in the custodian bank chain, you can only move money within the guardrails that are established by the template. And the template is the only people that can create a template is the internal audit department. They can't do anything once they set it up, but you're gonna, you can't just send money to any place. You got to send it to this bank, this account, or this manager. And that's set up by internal audit. And then when the investment team wants to move money, either add to that manager or create it, whatever the case may be, then that has to be actually worked up and by our finance department, which is outside the investment team. And then that has to come to me or the deputy for approval. And so, yeah, there's 3 people involved that aren't the investment team to move money, and that's part of our security. And then while I'm talking here, I should explain one thing that's probably not on the slides, because I think Treasury talked a little bit about, the different ways they allocate their investment results for the various funds. Well, we have various funds too. We have the Public Employee Fund. We have the Law Enforcement Fund. We have the Warden and Patrol Fund. We have 8 defined benefit plans. How do we work all that? Well, here it's pretty simple. At the beginning of the period, let's say the beginning of the month, the Public Employee Plan makes up 88% of the assets. And the Law Enforcement Plan makes up 6% of the assets, something like that. Whatever it is, then we operate for a month. And there's an investment loss or there's an investment gain. Public employee, and there's contributions coming in to an individual plan, there's benefits going out, and there's administrative expenses to be allocated. Well, if you're 88% of the business, then you get 88% of the investment gain or loss for the month. And then you look at the numbers, and there's money out for benefits, there's money in for contributions, and then you just do a reset for the next month because you might be not 88%, now you're 88.1, whatever it is. But that's how we do it, month by month, proportion of assets. That's also how we allocate common expenses. We don't have a case of copy paper for Fire B. We don't have a case of copy paper for the Law Enforcement Plan or stuff like that. We buy a case of copy paper, and for the month, the Public Employee Plan just bought 88% of that case. That's how common admin expenses are allocated too, unless there's something special for the plan. If there's a volunteer fire board meeting, like I had last night, those expenses and those travel expenses get allocated just to the volunteer plan.
Mr. Chairman,
Go ahead.
could we back up to page 18 under the operations and investment approval process? And so let me phrase my question here. So what would happen if you 2 gentlemen walked out of here and were walking across the sidewalk and God forbid a lightning struck and took you out? So then we're looking at the operations on the investment approval process. So is this process set up in statutes, rule? Is it policy, or is it just historic practice? And the reason I ask that is turnover. And what happens in turnover? What is the guidelines then? Is it the new CIO and the new director come in here and just with practice or change the policy? Or I just want to make sure that is what's working continues to work regardless of who's sitting in that chair. So within that investment approval process, where does that fit? Statutory, rule, policy, or just practice?
Mr. Chairman, Senator Hicks, yeah, that's a great question. So the board has investment authority. Within the investment policy statement, they delegate that to us. And so the board can change the investment policy statement at any time. So if Dave and I started wanting to make crazy investments, they could have a meeting and vote to change the investment policy statement and take that ability away from us. So that's the check.
And
Mr.
these things
Chairman,
are.
if I may, I'm more worried about the board without, long-term experience with new CIOs or new directors coming in and getting a little crazy. And so that's, how do we protect against that? And that's, I just think we need a little more framework than just the board. To me, it's a little bit of a red flag here that maybe we got an issue out there that at some point in time, I'm not saying that we need to do anything now, but as far as to take a look at, I'd like to see a more structured governance thing that's outlined at some level other than just at the board's discretion. That works fine as long as we got a great board.
Well, Senator Hicks, I would add that it is at the board's discretion, but it is formalized at the board's discretion. It's part of their board policy manual. All these things are dictated in the policy manual. Now, the board can change their policies. They would have to do that.
Is that Mr. Chairman, if I may, so does that go through the normal Administrative Procedures Act, public comment out there where people know that the board's changing their policy, or is it just they put it on the agenda at the next meeting,
Mr. Chairman, Senator Hicks, no, it's not subject to rulemaking process. The board has rulemaking authority, and they've adopted some rules, but their board policies and how they delegate the investment and what the guidelines are, that's not part of the rules process. It's just part of the board policy manual.
So, Mr. Chairman, if you will indulge me, gentlemen, what I'd like you to do is go look at some of your peer-type organizations and see what they do along these lines before, to me, I'm a little worried about this with just being able to change the policy by the board, but I'd like to know what the standard is out there for these type of public retirement programs. So if you guys could do a little research on that, and even if it's just a short memo that, you're consistent with what peer groups are doing across the United States for public retirement type programs and stuff. I'm curious.
Yeah, Mr. Chairman, Senator Hicks. So my opinion is it is best practice for the investment staff to make the decisions for a couple reasons.
I agree with that.
One of the big ones is then it's insulated from any type of political issues, and it protects a lot against fraud as well. So there have been instances where board members would try to make the fund make certain investments. So I think it was the Dallas Fire and Police, the board members were investing money in land in Hawaii and vineyards, and then they were taking all these trips out to visit them, and that was a major problem. So by having the investment professionals make the decisions, like, this is my livelihood. If I do anything wrong, I'm out of a job and I'll never get one again. I'll lose my credentials. So I have a lot at stake. Now, so the board delegates to us. We think that's best practice. If I'm understanding your concern, it would be if, let's say, the board took investment authority back, they didn't delegate anymore, and they started making investments. So one check to that would be the governor could fire the whole board and replace them, I believe. And I think that one challenge would be if there was a statute that said the CIO and director have to make all investment decisions. If you end up with a couple of rogue members, to change that statute, I believe you'd have to wait till the next session. I'm not sure. So that might handcuff you a little bit, but we can get more information on what other plans do. But
yeah,
So I get the
You
concern.
understand my concern.
I do,
and-
Mr.
And sometimes, we're not always going to have governors that were past treasurers and financial experts, and just the nature of the small state, we also have really close relationships with sometimes with people, and we get bad advice. And so but if you just do a little research on that, and just something I would like to take a look at. I don't know if the
In
rest of the
sum, I
committee
think
would
the
like
issue
that or
is,
not, but when you get something put together, if you can send it to me.
the board has adopted best practices. What would keep them from adopting lesser practices, right? Got it.
going to 21. So I feel like if we have the resources, we have a stable staff, we can continue to produce strong returns. Nothing's guaranteed, but that's what I worry about most. And I think we have a number of challenges. I think, obviously every governmental entity has policies and rules and procedures that are put in place to prevent waste, fraud, and abuse and improve transparency. The challenge is, and it works well for most of government, I think one of the challenges in the investment business is markets move really quickly. And if we need additional resources, we don't have the ability to do anything about it. And even if you're all in agreement with us you don't have the ability to do anything about it until the next session, and then there's a delay there. So, there are times if we think we need more resources, it might take 2 years to get them. And I think that's one of the things you've probably heard from the treasurer as well. It's just sort of the difficulty. And it's not a criticism of the process as much as just saying, the challenges that it creates for us. I'll turn to page 22, just looking forward. There are a number of challenges. I think that there always are in markets, but inflation, as you know, has spiked, and it seems like it's coming down a little bit now, but that's probably going to continue to be a problem. And that's going to create problems for central banks, because if there's a recession, they can't necessarily just lower rates to stimulate demand. They might stimulate inflation too much instead. There are high debt levels, which impairs the government's ability to increase spending if there's a recession. There's a lot of populism, which has created a lot of instability around the world. And then obviously geopolitical issues like Ukraine and China and Taiwan. So we're always going to have a lot of challenges. So our key is just focus on net returns, keep the staff stable, and just continuously improve. And I think when we have success, I hope you all realize this is your success too. The biggest steps we've had to improve performance have been approved by the legislature and governor's office. So thank you very much.
Yeah. Thank you very much, gentlemen. Anyone have a question? Senator Steinmetz.
Thank you, Mr. Chairman. Just one question. I saw one of your looking forward goals is having the ability to hire quickly. Are you having the same issues the treasurer's office is about turnaround time in hiring?
Yes, Mr. Chairman, Senator Steinmetz, we do have some of the same issues. So we have headcount caps, and then we have caps by position as well, which prevents us from promoting people. And then just generally the process, there are a lot of steps, a lot of hoops to jump through. And I'm not saying they're bad rules; they're all put in place for good reasons, but it really slows the process down.
Follow up, Mr. Chairman.
Go ahead.
Is the issue with HR or just rules you have to follow within your agency?
I think the issues within WRS, everybody works very hard, and I have no issues within WRS. I think it's more just the state policies.
Thank you.
Mr. Chairman, Senator Steinmetz, I would say we have fewer issues than Treasury has expressed to you. Usually it gets into a case if we have a staff departure and we're going to want to replace it as it was, then that process goes pretty rapidly. It's when sometimes you have a staff vacancy and said, well, now that person's gone, we want to reconfigure that position, and we don't think the labor market really is going to produce somebody exactly like that anyway. We need to reorganize, and I want to hire somebody slightly different. Now you're into a new process. You have to reclassify the position, redescribe it, and that does take some time. So it kind of depends on the situation. One of the things that Sam and I have mused about is like, especially for our analysts, we have two classes of analysts. We have analyst and we have senior analyst. Sometimes the market, if you have a vacancy there, you don't know what you're going to get. You might find that you're looking for a analyst, a junior guy, somebody coming pretty much right out of school, maybe with a year or two of experience. But here's somebody with 5 years experience, and they're looking for a job. Maybe Wall Street's in a downturn. We could hire them. Well, but we can't hire them at that level 1 salary. We'd have to at least pay them level 2. We don't really have the ability to do that. The other thing that happens is if I get a junior analyst position and we hired him right out of school, Sam's going to pay him rookie wages. But now he's been with us for 3 years. He's got his CFA. We put all this money and training and time into him, and now he's ripe for the picking. And if we haven't got a slot for him, then we're going to lose that person. It seems to me that we would benefit from ranging those positions. And I could have either a 1 or a 2, or even a 3. Maybe I ought to range the investment officer too, depending upon what their level of skill and experience was as determined by Sam and the board. That's what you do for attorneys. In the AG's office, you hire a junior attorney and they achieve a level of experience and skill, and they can make attorney 2, even if you don't have a fixed number of attorney 2 slots. You just promote them. That's what Wall Street would do. We're not going to let a seasoned analyst go because we don't have a slot for them. We'll just promote them. Now, at some point, you got to wait for somebody to die or retire. Not everybody can be the chief investment officer, right? But maybe at the analyst level, we should rethink how we're doing business there. It's a little too structured, in my opinion.
Mr. Chairman,
Yes, sir. Go ahead.
you know, I've sat on this committee for 5 years, and this is a reoccurring theme. We hear this, you know, and one of the reasons the treasurer's office has probably experienced at a higher level is because they've had a little more turnover and then a lot more addition of staff and personnel. But it's like a broken record, members of the committee. And at some point in time, what I would like to do is we need to address this, because it gets back to the whole effort here is to maximize the return on our investments. And if we have an internal impediment created by our own structure, then we should address that. So what I'd like to do, Mr. Chairman, is what I'd like to do is make a recommendation that WRS get with the treasurer's office and work with our LSO staff to what statutory things that might need to be changed statutorily that would allow greater flexibility and more discretion, at least on the investment and even the back office accounting side within treasurers and WRF. We're not nimble. We're missing opportunities for good people, as you've outlined already in here. The selection effect tells me the story, that if you got those good people that can select those asset managers versus the actual active investment guys with the treasurer's office, that's where the money's being made. And we need to make sure that we are nimble. And if we need to move from an analyst 1 to an analyst 2, you need to have that discretion for us to maximize our return. So what I'd like to do is have you guys get together with the treasurers and identify those issues. And Ian and Polly and Brian, if you guys can, you know, work with them on that. Mr. Chairman, I'd like to see that we come out of this thing sometime in November or December with a piece of draft legislation to address this issue. I don't know that we will, but I think we ought to start down that track, because we're losing investment opportunity by what we're doing right now. That's just I would make that as just a recommendation, Mr. Chairman, if the committee was inclined to go along with that.
Committee? Looks like I see a lot of heads bobbing up and down. Gentlemen, does that sound like a reasonable request?
Yeah, Mr. Chairman,
And,
Senator Hicks, yeah, we
We welcome the opportunity to do
With
that.
an
We'll have
aim
that for
toward
you
our
by tomorrow.
November meeting.
excuse me?
With an aim toward our November meeting. I think that's the next time we'll have a chance to address it.
That'd be
We
great.
can
We'd
have
appreciate that.
proposed statutory language or budget footnote language. I don't know which you would prefer. We can work it both ways.
No, Mr. Chairman, if we're going to do this, we need to put it in statutes. We need to codify it instead of, the budget realistically only is for 2 years. And so,
LSO staff, do you have an idea of what we're doing here on this one? Okay, thank you. All right. Do you have any more for us today? That's it? Well, thank you very much, gentlemen.
Thank you.
Appreciate it. Good job. Thank you so much. I think anything that LSO needs us to think about here before we adjourn? Okay, I think the committee is adjourned.